Hey everyone, welcome to this week's Intelligence Briefing. Let's face it, if you're serious about building multi-generational wealth, the daily financial noise out there can be, well, totally paralyzing. So today, we're cutting right through that. We're unpacking the Sovereign Capital Weekly Brief Intelligence Issue Number 1, and we're sticking strictly to the evidence, the data, and the macro indicators that actually move the needle for your capital system.
Okay, let's dive into this, because this entire explainer is engineered to help you answer just one absolutely critical question. What should I do next? We're going to look at how a truly disciplined capital system functions, filtering out all that market panic so we can focus on the long-term asymmetric opportunities.
To do that, here are our briefing modules for the week. We'll cover the global macro battlefield, monetary and productive engines, the Museum of Monetary Civilization, and we'll wrap it all up with a clear action map.
All right, Module 1, the global macro battlefield. Let's set the board.
So here's your 1-minute executive macro summary. Just look at the broad trends we're dealing with right now. GDP growth, pointing up, which means economic activity is expanding. The M2 money supply, which is essentially the total amount of cash and easily accessible liquidity in the system, that's up too. Long-term liquidity is staying heavily elevated compared to historical norms. Government debt? Yeah, structurally elevated across pretty much all advanced economies. And then there's inflation. While it's stable and definitely off its peak, it's still just kind of pointing sideways, you know? It's moderate, but man, is it persistent, sitting stubbornly above what central banks actually want. So what does this all mean for you? Well, growing economies generally support industrial demand and corporate earnings, which is absolutely fantastic for our productive capital. But at the exact same time, when you combine persistent inflation, sky-high debt, and a massive money supply, you've basically got the perfect backdrop for hard assets. It just reinforces why we absolutely need precious metals to protect our long-term purchasing power. The macro environment is constructive for sure, but it requires absolute discipline.
Moving right along to Module 2, monetary and productive engines.
Now, what's really fascinating here is watching what the world's largest monetary authorities are actually doing, rather than just listening to what they're saying. We're looking at official gold holdings here, measured in tons. The United States holds over 8,000 tons. Germany, over 3,000. Even the IMF holds nearly 3,000 tons. Think about that. Despite decades of crazy financial innovation, these colossal institutions are still holding thousands of tons of gold as a foundational reserve asset. They're operating on multi-decade horizons. Their reserve decisions aren't about trying to predict next month's gold price. No, they're designed to fundamentally bulletproof national balance sheets. So for us as disciplined investors, this gives us incredible context. Gold is not a trade, it's a bedrock reserve asset.
And within your own capital system, you really need to contrast their roles. Gold, that's your reserve foundation. It preserves your purchasing power. It anchors your stability. You don't buy gold because it produces a quarterly yield, you own it because it represents absolute monetary stability. Silver, on the other hand, well, that's your growth engine. Silver actually compounds. It participates in monetary demand, sure, but also intense industrial demand. This dual personality makes silver a much more volatile growth engine, which honestly is fantastic when you use it correctly within a broader system.
And right now, that relationship is sitting at roughly 67. That's the current gold to silver ratio. Now, when this ratio compresses, meaning it takes fewer ounces of silver to buy a single ounce of gold, it usually reflects stronger relative performance from silver. And that is exactly what we're seeing right now. Silver is outperforming gold on a percentage basis. But listen, a strong ratio does not mean we just go out and chase silver at any price. No way. It's a signal that we should maintain disciplined accumulation. We buy on meaningful pullbacks rather than chasing rapid emotional price spikes.
Now, while monetary assets preserve your wealth, productive assets actually create it. This is your productive capital engine. We're looking at businesses that align with massive, long-term structural trends. We always ask one key question: what essential problem would this company still be solving 10 years from now? So, taking a 7-engine approach, we have NVIDIA for AI infrastructure and Taiwan Semiconductor for critical manufacturing. Both are strongholds right now, and we're only adding on pullbacks. We're accumulating Freeport-McMoRan for copper and electrification infrastructure, and Wheaton Precious Metals for precious metal streaming. And crucially, this is key, we have a liquidity reserve, like the SPAC's money market fund. People forget, but liquidity is highly productive because it creates optionality. We aren't deploying every single dollar immediately. We're keeping our powder dry for exceptional opportunities, letting these core tech and infrastructure engines generate wealth while we stay flexible.
Let's slow things down beautifully for Module 3, the Museum of Monetary Civilization.
This week's featured acquisition is a 1779 Continental Currency $30 note. It's graded PMG 35 EPQ, which just means it's been certified to be in exceptional premium condition for something this incredibly old. But we aren't just presenting this artifact as some neat collectible. Actually, scratch that. It's more like an active asset class. This piece of paper represents the absolute birth of American money. Issued right in the middle of the American Revolution, these notes were literally created to finance the struggle for independence.
And this brilliantly illustrates why this specific niche matters so much. Think about it. Before there was the US dollar, before the Federal Reserve, before modern banking as we know it, there was continental currency. This specific $30 note sets the historical foundation for a highly curated, irreplicable collection. It has a strictly fixed historical supply, immense educational value, and essentially zero correlation with traditional financial markets.
Let's move to InC and see how this builds a really coherent narrative. When you organize things by the actual evolution of money, it transforms random, disjointed acquisitions into a true museum of monetary civilization. It's like a giant puzzle. The continental currency is step 1, the birth of American money. From there, we step into colonial American issues in step 2, then move to step 3, charting westward expansion with Carson City coinage, and finally expand out to step 4, capturing global history with British India rupees and ancient collections. You see, you're no longer just hoarding random objects, you are actively documenting the evolution of human trade.
All right, let's wrap this up with zero ambiguity in Module 4, the action map and next moves.
Here is your Monday morning decision board. Let's get straight to the marching orders. Buy. We are selectively buying historical scarcity that completes important chapters, and we are buying silver, but only on weakness. Hold. We are holding our gold dollars as our reserve anchor, and we're holding our core productive tech, like NVIDIA and Taiwan Semiconductor. Wait. We wait for exceptional entry opportunities. Remember, your cash is not just sitting on the sidelines taking a nap, your cash is actively hunting. And ignore, we absolutely completely ignore market hype, social media panic, and those daily price predictions that just cloud your judgment.
So, the crucial point is that this entire briefing distills down to these 3 highest priority moves for the week. Step 1. Continue building historical scarcity. It is, without a doubt, your fastest growing source of long-term asymmetric opportunity. Step 2. Stay patient with silver. Don't force it. Let the opportunities come to you. And step 3, continue funding productive capital. Keep maintaining those businesses that are actively solving tomorrow's structural problems today.
I want to leave you with this final thought. The greatest change we're seeing right now isn't actually reflected in GDP numbers or gold prices. It's reflected in how your own mental framework matures over time. You have to move beyond just waking up and asking, what can I buy today? And start asking yourself a much bigger question. What kind of capital are you trying to build? Are you just accumulating random assets, or are you intentionally designing a durable, multi-generational capital system? Think in years, not weeks. Keep your standards exceptionally high, and let the great opportunities come to you.